From San Diego, California, this is the Frug Life Podcast, the show that teaches you how to save, invest, and earn money. Here's the host, Mr. Frugal himself, Ricky Hirsch.
Welcome to the Frug Life. Recently, we covered bank runs and what happened at FTX. And actually, maybe I wrote the script a little longer ago than I thought, because that wasn't super recently. But anyways, what happened at FTX in many ways was like a bank run. But there was no FDIC insurance or financial safeguards. And so now we are seeing some actual bank runs at Silicon Valley Bank, at Silvergate, Signature Bank. All these banks are facing bank failure. And in particular with Silicon Valley Bank, the FDIC is playing an important role. Instead of all the depositors being out of their money, like with FTX, the deposits at Silicon Valley Bank are all being made whole. The FDIC is covering not just insured deposits, but all deposits. So what is the FDIC? The FDIC provides insurance on deposits. The limit is $250,000 per person per bank. So if you have a joint account, that's $500,000. And this is per financial institution. And so if a bank fails and it is under this insurance limit, you will get all of your money back. All of your money is fully insured by the FDIC. And so the FDIC will make sure that you get your money back if it's under that limit. Now, some clever financial institutions use this to their advantage and their customers' advantage. In essence, a financial institution can place deposits in other financial institutions on your behalf. And that way, you can get more insurance coverage than just the $250,000 or $500,000. So let's take a step back. Why is the FDIC providing insurance at all? Well, in a lot of ways, this is so depositors don't really need to vet their bank, which for an ordinary person might be quite an ordeal, right? Ordinary people are not in the business of evaluating banks for their liquidity, for their solvency. Instead, they should be able to just put money in a bank and feel assured their money is safe. Now, the FDIC is providing a service here, and so banks in turn pay fees to the FDIC for this insurance. And actually, calculating or estimating those fees due to the FDIC is literally part of my job. The fees are determined on a number of factors, including the amount of deposits being insured, but also on the riskiness of assets held by the bank. The FDIC looks at the various loans the bank is making and looks at categories that it believes are higher risk. It weighs them all differently, throws this all onto a scorecard, and that scorecard in turn determines the assessment rate and the fee amount the bank will pay. And I think this fee is important as it helps avoid moral hazard. Free insurance could be an incentive to engage in risky behavior. But because the insurance is based on the perceived risk of the bank, based on the risk of the assets it invests in, to the extent that the riskiness of those assets is real, and to the extent that risky behavior is captured in the scorecard, I guess I should say, this is an effective way to make sure that the banks don't behave in risky behavior. Or to look at it in a slightly different lens, if the FDIC's fees correctly align incentives, the bank will be incentivized to do the right thing. But that's all a bit of a digression. In this most recent case, though, Silicon Valley Bank is about to get some free additional insurance. They paid for $250,000 of insurance per person, but in reality, everything was covered. Now, this was done perhaps wisely so, because if so many companies lost access to their funds all at the same time, that could have pretty bad economic repercussions. Otherwise, profitable companies might be unable to make payroll. In turn, those employees might not be able to pay their mortgages. The company's suppliers may lose their receivables and default on their own suppliers. And basically, this could create a cascading ripple effect, destroying jobs, causing people to lose their homes, and creating this giant ripple through the economy. Now, I lived in the Bay Area for a time, and I audited tech companies in the Bay, and Silicon Valley Bank was ubiquitous there. All the big tech companies had accounts. Well, not literally every company, but to my recollection, many. And as a first-year auditor, my job was to ensure the cash listed on that company's balance sheet was real. And so I personally confirmed account balances at Silicon Valley Bank. Now, of course, that was a while ago. And so I do think the decision to save the depositors was likely a wise one. So what can an average person take away from all of this? Well, if your deposits are less than the FDIC insurance limit, you're safe, and that's mostly it. Banks undergo test procedures, almost like a fire drill. And in this fire drill, the FDIC steps in and says, if we shut you down on Friday, can you produce a list of all deposits under the FDIC insurance limit? And then the FDIC will get that list and resume service on Monday. So everyone under that limit can withdraw their money on Monday. And I guess the point I'm making here, though, is if you are under the FDIC insurance limit, even if your bank fails, the FDIC will step in. They will have everything up and running reasonably quickly, very likely, and you'll be able to get your money out of there without too much issue. Additionally, if you don't want to put your money into a bank, you have some other alternatives. There are very short duration treasury bills, which have a little less liquidity than cash, but are still risk-free. I suppose there's a bit of an asterisk there. In finance, we often refer to U.S. government bonds as the risk-free rate, which T-bills are short-duration U.S. government bonds. Now, I do want to warn you the yields on these are very low. What's potentially nice about them is that you can buy way more than $250,000 in T-bills. You're not bounded in that way. Now, as an individual, you can generally manage your money in just a few bank accounts, right? You don't need to keep literally millions of dollars in cash, as it has a poor yield, and it probably means you're not investing enough. But if you did need to keep cash for whatever reason, right, you could use T-bills like I mentioned. You could look for a bank that had a cash program that I alluded to earlier, one that will deposit your money into other banks on your behalf, and you get more insurance because of that. Just one other note, I spoke about the FDIC in this episode. If you use a credit union instead of a bank, they have something called the NCUA, and the NCUA is much like the FDIC, but it's for credit unions. I think I want to note one other thing, which is that some institutions have non-FDIC cash products, or not. I'm not sure if cash products is the right word, but items that look like they are similar to bank accounts but aren't FDIC insured. These sometimes have a higher yield, but you just want to be aware of what you're getting into. The FDIC insurance is valuable, but it also has a cost associated with it. So an institution cutting corners may avoid that cost and be able to pass on some of the savings to you. Just be aware that they're also passing on more risk to you as well. So you probably just want to keep that in mind. Now, all of this episode is to say, panic probably isn't the solution. You should just understand the products you are using and how you can protect yourself adequately. All right, let's take a quick break and we will be right back. Welcome back. I just wanted to first provide my usual disclaimer. This is not investment advice. This is not financial advice. I'm just sharing my understanding of the FDIC. And that's all it is. It's just my understanding. So please excuse any factual inaccuracies. And if you find something that you do think is inaccurate, please let me know and we can make a correction. If you have any other commentary you want to give me, please feel free. If you have commentary about the FDIC, that would be wonderful to have. One other interesting thing that I learned recently is that if you have money, or securities, I really should say, or cash in a brokerage type account, like a Charles Schwab, for example, there's actually a different type of insurance that might be in play that is called SIPC insurance. And SPIC insurance protects against loss in cash and securities. The limit on SIPC insurance is $500,000. And this has a sub-limit within it of $250,000 for cash. And just to be clear, this would only protect you if something were to happen to the broker-dealer that is holding your securities, right? It doesn't protect against your stocks going down in value. But I think it is interesting that there are more types of insurance. It's not just the FDIC or the NCUA. There's even stuff for broker-dealers as well, which I think is all very nice for ordinary consumers and ordinary people who just don't have the time or perhaps even the ability to evaluate these financial institutions, which may be an episode for a future day, how to evaluate a financial institution. Because we do have a little bit of a banking crisis on our hands. Not all banks are created equal. There's some attributes we can look at to see which banks are riskier than others. And now I don't want to dive into it too much right now, but one factor you can look at is what % of their deposits are FDIC insured. If a bank has almost all of its deposits FDIC insured, then there's really not too much reason for people to panic and take their money out, because even if the bank did fail, their money would be protected. In contrast, a bank with most of its deposits not FDIC insured, like Silicon Valley Bank was, if a risk of contagion or a fear that the bank might fail occurs, even if that belief was without merit, just that belief existing kind of gives merit to it, right? Because if the bank did fail, there would be consequences. It's all a little bit circular in a way. Anyways, thanks for listening to today's episode of the podcast. I hope you enjoyed it. Have a good week or month or whatever cadence I'm releasing these at now. And as always, stay frugal.